Hi and welcome to Swissquote's Daily Market Talk. It's Wednesday, June 25th. The ceasefire between Israel and Iran seems to be holding for now, though it is holding on Donald Trump, who otherwise gets very, very angry with both of the countries. But whatever it is, the Middle East tensions are de-escalating, and the latter pushes oil prices lower and the major US indices back to all-time high levels where investors think they belong to, along with some dovishness. So we will talk about all that and more. But before we do, please keep in mind that opinions are my own and this is not financial advice. So tensions in the Middle East de-escalate after both sides fired missiles to each other, and Donald Trump said this.
I'm not happy about that. You know what? We basically have two countries that have been fighting so long and so hard that they don't know what the fuck they're doing. Do you understand that?
It was pretty effective, at least from the market point of view. Oil prices further fell. US crude dropped another 3.5% yesterday, and the barrel of US crude is now down by around 15% since the Monday peak that was reached at the opening bell. The bears are now out testing the critical $65 per barrel level support, which coincides with the major 38.2% Fibonacci retracement on the year-to-date decline, and if broken could signal the return of oil prices to the negative trend that has been building since the start of this year. A negative trend, a bearish trend that is actually supported by a quickening restoration of OPEC oil output and the waning global demand prospects due to Donald Trump's trade war and uncertainty regarding the tariffs. Brent, on the other hand, already consolidates below its own major 38.2% Fibonacci retracement and is testing the 50-day moving average to the downside, while the natural gas prices return to $3.60 per MMBTU level after having tested the 4.20 level at the peak of the latest Middle East tensions last week. Now, obviously, this waning stress in the energy markets and in energy prices is excellent news for everyone out there who doesn't want to see higher oil prices translate into accelerating global inflation and tighter monetary policies as a result of it. So the market mood is quite well restored, to say the least, and the Fed, those are pressing the lemon particularly hard these days. The Fed Chair Jerome Powell said in the first day of his testimony before the Congress that they do not want and they do not need to rush toward interest rate cuts. But when he was asked for the July meeting and whether there would be a rate cut, he didn't say, no, we won't cut in July. He said, well, we will see. So the latter was enough to get the Fed those dancing in the streets yesterday. The US 2-year yield just dropped below the 4.80% level this morning as the probability of a July rate cut from the Fed jumped from none to 20%. Middle East de-escalation combined with the rising dovish Federal Reserve expectations sent S&P 500 more than 1% higher at yesterday's trading session to almost near a record high level, while Nasdaq 100 printed a fresh closing high. The US dollar fell. Now, all this is great, but raises a few questions. First, Jerome Powell, who said just a week ago that everyone that he knows actually thinks that inflation in the US will be rising significantly due to tariffs, well, has been squeezed yesterday like a lemon so that investors and the markets could get a few drops of dovishness out of him, and the latter was interpreted as being a potential green light for a July rate cut from the Fed. But the thing is, cutting the interest rates in July would be nothing more than rushing toward the interest rate cuts, as well the trade uncertainties persist and they will not be resolved by July. In the best case scenario, the United States will go ahead and impose its tariffs on the major trading partners without further negotiating, and the tariffs that would become effective in July or maybe in August will not be reflected in consumer prices before fall the earliest. And in the worst case scenario, well, the tariff deadline will be kicked down the road on excuse that the geopolitical tensions in the Middle East delayed these trade negotiations, and well, the uncertainties regarding the tariffs will remain, and inflation risk will be just kicked down the road as well, but they will not evaporate. So even if the Fed is seen cutting the interest rates twice before this year ends, well, it would be more reasonable for them, in my opinion, to wait at least until September to see what happens with inflation, and maybe even October to proceed with these rate cuts. Because you know what? The US economy is obviously giving signs of stress with these tariffs and uncertainty and the rising yields. The house prices fall, the mortgage rates are high, and the latest consumer reports are volatile. One day they are good, and the next day they are bad. Overall, we see that the confidence is actually being hurt. But on the other hand, company earnings remain strong. The stock prices in the US are near all-time high levels, if not at all-time high levels. The stock valuations are obviously inflating. The jobs market remains resilient, and well, the Fed should keep some margin to intervene if things got worse from here, because it can't just cut the interest rates now when things are okayish and heat up the economy and not have options left further. But I'm not the Fed, obviously, and I don't know. But what I feel, however, is that the dovish Fed expectations are being pushed to the extreme right now. The long positions are overly crowded among the retail traders, while the CFTC data clearly suggests no such interest from big players near the record high levels, while risks are looming. So I think that the latest rally is probably a time bomb. There needs to be some downside correction, and factors that would justify such correction, which is unfunded Fed optimism, looming trade uncertainties, and exploding US debt, are in full play. So, in my opinion, every point that is added to the S&P 500 now increases the size of a potential drawdown later. In Europe, the convergence trade is clearly not holding up well, with the rising dovish Fed expectations and the possibility of a pause to rate cuts from the European Central Bank. Because remember, that divergence of a more hawkish Federal Reserve and a more dovish European Central Bank outlook was one of the major drivers of the US-Europe convergence trend at the start of this year, and it is weakening right now with rising dovish Fed expectations. So the STOXX 600 index actually rebounded more than 1% yesterday as well, following a 4% correction since the middle of June, but the S&P 500 is back being bought more roughly these days. And the European defense stocks that have been carrying the European indices higher in the first half of this year have probably priced in most of the benefits from increased government spending in military and defense. There could actually be another leg up if the US doesn't confirm that they would be there to protect any NATO member in case of an attack. So that's a major worry of the moment and the meeting that's going on in Hague right now. But the rest of the European stocks are still facing the tariff uncertainty. So my worry here is that the last bricks would make the tower just too high to stand on its own, and we could see a sizable downside correction on both sides of the Atlantic Ocean sometime this summer, unless we have good news on the wire regarding the trade dispute. And if that's the case, if we see a sizable downside correction, at least it would justify the rising dovish Fed expectations. So this is all for today. I'm İpek Özkardeşkaya, and thank you for joining me, and thank you for all your beautiful and supportive comments. I hope this episode of Market Talk has been helpful and it has been insightful to you. So please do not hesitate to leave your comments, your reactions, and your questions below. Follow us on Instagram, on X, on LinkedIn, but also on WhatsApp, Threads, Telegram, and Blue Sky for regular market updates. Subscribe to our YouTube channel for daily market comments, and please don't forget to hit the like button on these videos to let us know that you enjoy them. So I will meet you again tomorrow, and until then, good day trading.